Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
Daddy, can I drive?
Yeah, sure, why not?
Let's get behind the wheel. We'll go driving.
Do I look like I drive a minivan?
Shut up and drive.
Don't drive angry. Don't drive angry. I'll drive. Shotgun.
This is the drive to the close
If you had access to a car like this, would you take it back right away?
on Bloomberg Radio.
All right, everybody, we've got just about 19 minutes to go until we wrap up the trade on this Monday. As you know, we've got stocks bouncing around, but really holding on to their best levels of the session. Bouncing, meaning they're way off their lows today, up 1.6% on the S&P 500, 2.25% higher on the NASDAQ 100. So the risk on trade is certainly out there in a big way. Let's get to our Eric Weiner. He's Bloomberg News Senior Editor, Equities Americas, joining us right here in our Bloomberg Interactive Broker studio. As Bill Maloney was leaving and we're listening to Alexis and we're all talking, and Tim, I think you leaned over to Eric and it's the end of an era in terms of Warren Buffett, right? Talking at his annual shareholder meetings. We all look to him every year, and really in moments of crisis, he was the voice that really investors wanted to hear from.
Absolutely. He also was a sort of a voice of reason on Wall Street. So he would be one who would point out that things had gotten a little bit far, out over their skis. He would be the one to say that it was time to step back in. They called him the Oracle, and there was a good reason for that. We're not going to see something like that again for a very long time, if ever.
Remember that 2008 op-ed in the New York Times? Buy American, I am.
Yep.
This was at the depths of the financial crisis. Everybody's freaking out. He writes, I've been buying American stocks. Why? A simple rule. Be fearful when others are greedy, and be greedy when others are fearful. I feel like I hear that repeated all the time now.
It's so easy to say. It is so hard to do. And it's not that simple in the sense that, like, what he saw, the way that he hedged himself, he was a very heavy user of derivatives. Nobody really ever points that out. He would always hedge himself. He was just really, really savvy with what he could see in terms of demand and what he could see in terms of the permanence of the American consumer, that he could tell that there was, like, he was in front of newspapers when that was the only way to do advertising. He was in front of Coca-Cola whenever it was saying, yeah, that's not going to be the thing to buy. And he's like, yeah, but people just like a Coke. It's those kinds of really, really simple.
Like Peter Lynch, right? I need to understand the company.
And then bring that in with very, very sophisticated positioning within his portfolio. And you don't see that kind of thing anymore.
Yeah. Is there somebody out there that you think, I think about how much we listen to what Jamie Dimon has to say, and I do feel like he is the lone remaining big bank CEO that was there during the great financial crisis. All the others are no longer in that top spot. So he has definitely seen a lot and has really created a bank that I think people turn to and respect very highly.
Buffett believed in Jamie Dimon.
Yeah, he did.
I remember I interviewed him.
And they appeared together often.
Yeah. I remember when I interviewed him for my first book, and he had left Citigroup and was debating going to Bank One. We actually talked about this. Yeah. And I just had a feeling that he was a guy who a bank could use. He was already eyeing how to put things together. He's just a really, really savvy individual in terms of the way finances work. Buffett was different in that he managed portfolios. He really put his money where his mouth is. Diamond understands an industry. Buffett understood industries, and that's unique. So
I guess the question I have is, like, there's not, look, he's He's still with us.
No,
okay?
yeah.
We're talking about this because
But we've been seeing the transition slowly happening and putting people in charge to continue Berkshire Hathaway for the next 50, 100 years, what have you.
he's expected to hand his role of CEO to successor Greg Abel at the end of the year, but it doesn't matter. There's no, when people listen to Warren Buffett and Charlie Munger, who passed away just in the last couple of years, at the annual shareholder meeting, those were like events that people would flock to from around the world. I don't see anyone else having that same draw.
No. And it's also because they spoke about macro issues. They spoke about the world around them, and they addressed issues that affected you, whether or not you were investing. So it was like, the Woodstock of capitalism, they called it. But it's unlike a normal shareholder meeting where they're talking about their business, they're talking about the company. He was talking about the world, and Berkshire was a part of the world. The most amazing thing about him was that he was a real portfolio manager. If you look at him from the 60s, the return is insane. And then he built a conglomerate and ran that successfully too. I mean, who can really do that? That's just not in the cards right now for what's available to you in this economy.
I also think, when you think about something like Graham and Dodd, like he was their method, the, value investing. I mean, that was the foundation for Warren Buffett. And, we talk about value a lot, but he really did it and did it well.
And it's the courage of the convictions.
Yeah.
Like he could spot what he felt was undervalued and then pile into it and be right.
One thing that we love doing is talking to CEOs of companies that are owned by Berkshire Hathaway. Dan Sheridan was on with us just a few weeks ago ahead of the New York City Marathon. He's the CEO of Brooks Running. If you missed the conversation, check it out.
It's great.
On our podcast feed. But he made the comment to us, like, he doesn't get micromanaged by Berkshire Hathaway executives.
That was the whole point.
He just does his thing.
He bought managements that he believed in and then gave them the room to do what they were going to do. It's such a bizarre level of confidence where we take confidence as intervening, as stepping in. I know better. What he knew was he could spot a good company and good management and then give them the money that they needed to succeed and get out of the way. And that is like the most admirable level of confidence that you can have.
And someone who invested, yes, in publicly held companies, but private companies, whether it's See's Candies or whether it was Brooks. I mean, there were so many.
Duracell, Charter Brokerage, Benjamin Moore.
Yeah.
Geico.
And bought at the lows. And bought at the low. Like it would see these brands when they were discounted and go after them.
My favorite is See's Candy.
I know. Every time I'm in an airport, I'm like, gotta get the nuts, the nuts and the chewy ones.
Yeah.
I really love them. Hey, just got about a minute to go. Just quickly, the trade today, it's obviously risk on. I don't know, but does it feel like it has conviction?
Well, it makes sense in that if you were worried about airplanes getting off the ground and you were worried about like things being, crushed to a halt by the shutdown, that appears to be ending. However, the risks in front of us are the Fed and what they're going to do.
Still here.
Earnings look great, but where the economy is going to go, where jobs are, those questions aren't answered. But today you should be buying. Like if you sold last week on the chaos, today you step back in.
Yeah, exactly. Right. And you definitely are seeing investors doing that. Eric, thank you so much. Love
we can go anywhere
perspective.
with Eric.
I know.
I love it.
Like the perspective on Buffett. Very cool stuff. Eric Weiner, Bloomberg News Senior Editor, Equities Americas.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, today, the White House expressing support for the bipartisan deal to end the U.S. shutdown, a key development that makes it likely the government reopens within days. We shall see. The Senate is resuming deliberations on its deal with centrist Democrats, but has yet scheduling a vote for final passage, although I'm hearing some talk that it could happen maybe later this evening.
Okay, we'll be tuned to that. Senate lawmakers also still must wind its way through potentially time-consuming procedures, and then the House members must travel back to Washington to vote for the first time since September 19th. That's a little bit of Schoolhouse Rock.
Yeah.
Is that?
Yeah. But you can leave, I guess,
You can.
when the government shuts down and still get paid. But yeah. Okay.
Oh, okay, Carol Massar, go ahead.
Off my
all
soapbox.
to you.
All right, let's see what the co-founder and director of economic policy at Veda Partners has to say. She is Henrietta Trey's, certainly a friend to us all here at Bloomberg. She joins us from New Orleans. Henrietta, glad you could join us. We talked to you. The surveillance team does a lot in terms of what's going in and around the Beltway. So is this real progress? Is it a political win? And if so, for whom?
Yeah, we definitely have progress overnight. Very excited about it. I'm optimistic that they will be able to get the House vote done as early as tomorrow. I think there's no better Veterans Day gift to give to our veterans than making sure that the military are paid and all the 700,000 furloughed workers can get their paychecks and some back pay as well. So hopeful that that starts moving forward. For investors, the most important thing is that we're open by Friday. So we might start to get some BLS data from September. I think that that's possible. Staff's still getting briefed, but that's my expectation. And fingers crossed we're there.
Do you think this is a solution?
Yes. I mean, I think that we've got the final package. We're going to have opportunities to keep having these ACA subsidy fights into December. And then we know that there's a January 30th CR. So we'll have the same exact fight all over again. Some of my smartest clients are saying, what are the odds of a continued, round after round of government shutdowns? And I think that if you look at what the two sides are taking away here, the Democrats are mad that they caved, and the Republicans, and in particular President Trump, have suffered quite a lot just on their own personal approval ratings. So it's kind of like playing chicken with a crazy person. They're happy to see what happens, and that's what we walked into this time.
Does it seem like Democrats gave in on this? They're not getting what they wanted.
Yeah, to the far left, that's definitely how they view it. They wanted the actual ACA subsidies extended. You can see why. For voters over the age of 60, your ACA premiums are going up $919. It's pretty substantial. The average one for people in their 20s, 30s, 40s is almost $200. So these are, very real benefits for, I think it's 42 million Americans. So definitely something that Democrats wanted to see delivered. But the good news for them is that they got the fight back on the front burner. And when you were standing at a low 30% approval rating, you really don't have much further to drop. So the Democrats getting engaged in this fight and pushing back against what has otherwise been, 10 months of Trump running the board is not all bad. On the Republican side, for President Trump, his disapproval rating has doubled since October. So there's a lot of reason to think that even though the ACA subsidies didn't get extended, Democrats fought the right fight. I think that that's what Schumer and Jeffries believe.
As we watch the political fights that go on in Washington and have for a long time, no matter who's in the White House, at least over the last few administrations, I think it's safe to say, Henrietta, what really struck us all, and I want to go back to those SNAP benefits, that 1 in 8 Americans need food assistance. Why is that? What does that say about lawmakers, Republicans and Democrats, through several White Houses and the job that they have not been doing for the bulk of Americans? I mean, aren't we the world's largest and richest nation?
Yeah, we sure are. And I think it's important to note that 70% of those recipients have full-time jobs. So it's not like these people aren't working. A disproportionate number of them are young people and also old people over the age of 60 or 65. But, if you really want to get into the nitty-gritty, why are people, 70% of these recipients, on food stamps if they have full-time jobs? What is their pay? I think there's some really interesting, conversation that always comes up when we talk about SNAP benefits of what are these giant corporations, Walmart, Target, Dollar General, et cetera, what are they paying their employees that they still also need to have food stamps? So it's really everyone to blame here on this front.
Why is this, though, not something that gets pushed further in Congress with lawmakers?
Well, especially in a year like this one where they're focused on cutting federal spending. I mean, and you look at the One Big Beautiful Bill, there were repeated instances of cutting food stamps back, limiting eligibility, all in the name of saving money, which is, interesting given that it was a $3.5 trillion deficit increasing bill, and they eliminated the current policy baseline, which forces Congress to pay for things going forward. So the decisions around trimming federal spending are very proactive. They're on purpose, and that was across Medicaid and SNAP in the One Big Beautiful Bill. So I don't know that this is necessarily seen as a problem to see the limitations. part of making the government smaller, which is what Trump and the Republican conference are trying to do.
Let me throw on top of this, and forgive me, I don't have the details right in front of us, but we were talking about this in the newsroom that the president is now proposing giving Americans a $2,000 check. Like, how do we do that? I don't understand. We talk about deficit, and if the economy is doing well, why do we have to do that?
Secretary Besson said it could come in the form of tax cuts.
Okay.
But the president also saying today that any extra would go down to pay the debt.
And that's exactly the problem. There is no extra. So the trade deficit, the tariffs is my bread and butter. And I would just say the following. When we did the CARES Act under President Trump's first term at the height of the pandemic, we sent out rebate checks. The president was very happy to send those checks out. They were very popular. They cost $292 billion. The tariffs have thus far this year for IEEPA brought in $89 billion. So if you're going to increase the rebate check from $1,400 to $2,000, and presumably there'll be a qualifying child credit of $500, something along those lines, you now have to spend $400 billion of the $89 billion in revenue that you brought in from tariffs. And why are you sending the rebate checks in the first place? Is it because costs of goods are increased? Is it because of the tariffs? It sure enough is. So you have this really circular logic that's a huge problem, and there is no leftover revenue to reduce the deficit, which is, of course, what bond markets are so focused on.
Hey, Henrietta, just last question on healthcare and whether or not Republicans come to the negotiating table in good faith when it comes to the Affordable Care Act later on. That's what Democrats want to see. Does that can get kicked down the road to January, and do they meet?
I've gotten that question a lot this afternoon from clients. I think yes. When I speak with Republican staff, they say that it's going to take 2 or 3 weeks to hammer out any kind of an agreement on income cap levels, on the Hyde amendments related to abortion, on the phase-in and the duration of any ACA subsidies. I think it's a bridge too far to ask this extremely acrimonious Congress to come together in the 12 legislative days they have before the end of the year to get a solution. I think it's much more realistic that they need a deadline, and so January 30th, that January time horizon, is probably going to be more intense around the ACA subsidies getting extended or not.
All right. So, Love, thank you so much. Henrietta, co-founder and director of economic policy at Veda Partners. Henrietta Trey's joining us from New Orleans. All right. That's the latest, Tim, on the U.S. government shutdown. And expectations that we're nearing an end has definitely put the risk on trade on Wall Street.
Yeah, traders rush into the riskiest corners of the market. Stocks climbing alongside Bitcoin as the U.S. Senate advanced a plan to end the longest ever government shutdown. Also removed significant economic headwind. Bonds edge lower. We've got a great guest back with us. Allie McCartney is Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. She's got more than $1 billion in assets under management. She joins us here in the Bloomberg Businessweek studio. The risk on trade today, sustainable? I mean, it seems like we're seeing the riskiest corners of the market get a bid.
We've seen a lot of back and forth in this kind of trade. So last week was the worst week for the NASDAQ since April, since we began the tariff tantrum. So what happened last week, I think, was a combination of a lull in earnings news. First of all, we had gotten all the good earnings news out, and then everybody waits till NVIDIA. We also had the end of October, which is a fiscal end for a lot of funds. So there was a lot of purging and taking profits. And then for whatever reason, the sentiment and data was really unpleasant last week. And people chose, investors small and large, retail investors chose not to show up, which has been the bid that's been getting the market through. And they chose to focus on things that, given what you just talked about, are not particularly surprising, like the lowest consumer sentiment out of Michigan ever, right? So I think, when I look at everything that you talk about, and I love the way that you talk about it on this show, because it's from an economic perspective, but also from a social and human perspective, clearly what's happening is the low-end consumer is getting squeezed. Things are much more expensive. There are probably many of those people who are on SNAP benefits who haven't gotten paychecks in a long time, and they're having a real hard time, and they see in that Michigan sentiment number more hard times. Whereas you look at the 5 or 10% that now spends 50 to 60%, and what are we seeing? Markets are at all-time highs. AI is increasing the productivity of our jobs and our labor. We see interest rates going low, so we can probably have more of a tailwind and more of an ability to borrow. But that same movement in interest rates doesn't give the general population access to a housing market. So we really are like a tale of two cities right now.
Right. Right. I mean, that's the other thing about access to lending. Who really gets it ultimately, right? And I thought it was striking what Henrietta said, that 70% of the SNAP recipients have full-time jobs.
That shocked me. I was very surprised to hear that. That's not the narrative that I think we push on Wall Street or from a government perspective.
We've got one of our reporters on shortly, Mark Niquette. They've got a story out on the Bloomberg. It's Trump's economy now, and Americans don't seem to love it. And they get into how the U.S. economy, Allie, is so increasingly dependent on three narrow interconnected A pillars: affluent consumers, artificial intelligence fueled investment, and asset price gains, making it less stable if any of these pillars weakens. Those are kind of the three pillars of the market run up.
They absolutely are. It is not hugely atypical of sort of the end of a bull market or a boom cycle.
Yeah.
And the question that everybody's asking now is not if, but when, right? These are called cycles for a reason. Portfolios are built the way they are to have things that go down when other things go up. You're not supposed to have gold rally 65% while stocks are up 28%, while bonds are sort of mildly up. So we are in a very strange period where something will have to give. The question is when, and will it be on the federal side? Mm-hmm. Will it be on the AI side? Because, the thing
What do you think most likely?
The federal side is interesting to me because the AI side, I see that there is a concern and an issue around circularity of investments, circularity of hyperscalers, circularity of financing. But I also see and believe that this is transformative and catalytical, like the steam engine was, like telecom, like electrification of the grid. And this, not surprisingly, is happening quicker than all of those other capital expenditure cycles happen. But it's actually not from a percent of GDP perspective concerning. It actually probably has a lot of room to run. So I think that, the affluent works until it doesn't work. And whether that's because it gets litigated away or redistributed in some sense, again, not a conversation we have in terms of portfolio managers on a daily basis point. But what all this means to me is that every day I have to wake up and ask myself three questions with everything I own. Is it time to buy it? Is it time to sell it? Or do I not yet have enough information to make a different decision? And the truth has been that there have been times in the last year, for example, where the answer has been sell a little, or the answer has been buy a little more, or the answer is I need to wait to see what happens with tariff negotiations. But nothing that happened last week in that sort of purge or today in Monday's excitement makes me change any of those three issues.
So you're not buying, you're not selling, you're waiting for more info?
We're waiting for more info. The one thing we are taking advantages is given all of the massive uncertainty, long-term, short-term, Wall Street, DC, I'm still happy to buy gold, palladium, silver. Though there's more gold buying this year than we've seen since 2011. It's catalyzed by distrust in the U.S. government, concern about national treasuries, full stop, alienation from the U.S., declining dollar. All of those things are going to continue. And when you look at the other precious metals, they have a lot of the same catalysts, but also with a real demand against a supply constraint. So those are interesting to me. And then to the extent we can get into some of those mega caps or into some financial names at lower prices, those are interesting given all the tailwinds behind them.
You tie it all together, as always. Thank you so much. Really appreciate it. Allie McCartney, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners over at UBS.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, listen, when Magna International reported earnings on Halloween, shares of the auto parts manufacturer rallied as much as 7% intraday in response to third quarter sales and adjusted EPS beats. Magna management also raised its fiscal year sales forecast thanks to strength in North America and China. There was a lot going on. Company based in Canada, biggest automotive supplier in North America, everything from automated driving and control modules, powertrains, lighting, mirrors, complete engineering systems, so much. It is a great read on the auto economy.
Back with us is Swami Kotagiri, president and CEO of the nearly $14 billion market cap auto parts maker Magna International. The stock up close to 18% so far this year. I want to start with kind of where we left off when we spoke to you back in April. This was just after the president's so-called Liberation Day tariffs. You liken them and the additional cost to drawing upon the playbooks from past rotating UAW strikes, COVID, the great financial crisis, the chip crisis, all rolled together. We were pretty shocked about those comments because you said it was big. Is it still that big of an impact? Has it been that big of an impact?
Hi, good afternoon. Thanks for having me. Yes, there has been a lot of dynamic challenges in the industry, as you know. And when you spoke to me last, it was fresh, at that time. As we sit here and look at it, I think our annualized tariff impact is roughly in the range of $200 million. But we continue to work with our team, with our customers, with our supply base in mitigating as much as possible, adhering to the USMCA compliance. All in all, I think we have been able to, with a lot of self-help, a lot of work with our customers, we've been able to bring down that impact to roughly 10 basis points, which means about 30 million for Magna this year.
So I will say our BI team reacted to our Bloomberg Intelligence team, Swami reacted, and they said they believe that your company's continuous cost cutting and operational excellence could further release margin gains in 2026. And they talk about in the U.S., major customers are benefiting from a more profitable sales mix with higher sales of pickups and SUVs offsetting lower EV production, which should enhance Magna's program economics for upcoming 2026 launches. Do they have it right?
Yes, they do. There's a lot of hard work, and thanks to the team, there's been a lot of traction in our operational activities, including some of the activities that you mentioned, cost restructuring, optimizing our operations. We have really worked through about 40 divisions in terms of restructuring, consolidation, bringing things together. And when the mix and the volume become stable and it comes through, you see profitability going to the bottom line. And that has been our focus: cost reduction, margin expansion, and free cash flow generation. We have talked about 150 basis points over the last 3 years. And I'm glad to say we have an additional visibility of 35 to 40 basis points going into 2026. So this is a journey. It's never going to stop. You're in an industry that we need to constantly work on improvements. We call them continuous improvements, and we're starting to see the result of that.
But you did talk about demand destruction in the short term when we talked with you in April, right after Liberation Day. Has it played out as bad as you expected? And where are we today? Your top customers are a who's who of the global auto industry. So where are we today in that demand destruction? Are we done?
I wish I could have that crystal ball, but the way I look at it is we peaked out as an industry in North America about 17.5 million units. Interestingly, I was looking at the data, go back 20 years in 2004, 2006 timeframe, North American production volumes were somewhere between 15 to 16. We are still at 15 to 16 million units today. I think the volumes held up this year, but I always like to stand back a little and see where was Magna. Magna 20 years ago was a $20 billion company. Today, we are a $40 billion company. And it's the result and the efforts of the team to continue to gain CPV and to diversify our customer base. And that's where our focus is, right? And to your point, though, I hope this is the trough. If you look at the average age of the fleet, it's pretty high. The inventories are pretty normal. So I like to say, there is elasticity of demand that's going to come back looking forward if there is no more externalities like we have had in the last 4 years.
Your company is based in Ontario. We are curious about the U.S. and Canada trade negotiations, or lack thereof. Given the impasse between the U.S. and Canada, how is that affecting your industry and you specifically?
Yeah, as you know, auto industry is a very interdependent ecosystem, and it's pretty complex in North America. So it has been challenging, but I would like to look at Magna really as a global company. We have tens of thousands of people in Mexico, in Canada, and in US. And obviously, we are following the footprint of our customers, looking at the economics, looking at transportation, looking at logistics. And that is the competitiveness that ultimately lets you be the player that you are, right? So the focus has been on it. Whatever the policy is, if there is certainty and visibility to the policy going forward, I think it's just going to be a tailwind to everybody, the OEMs and the supply base in all.
But Swami, is it broken? The U.S., Canada? I mean, it's been so intertwined, really, the North American, global auto supply chain. But is it, especially the U.S. and Canada, is it changed forever?
Again, I'm not an international trade policy expert speaking from a
but you have a great
perspective.
vantage and a great window on how it has worked and how it feels today.
It's definitely been strained, right? There is no question about that. But I've lived in this industry for 26 years, and what we're talking today is going to impact maybe 27 or 28. So we're always looking at what we're doing today impacts 3 or 4 years down the road. What we're doing today has been planned and decided 3 or 4 years ago. So I tend to think a little bit in longer cycles. I'm still hopeful that the policy is going to get to a point where it's mutually beneficial to everyone.
The president in the past, the president of the U.S., has talked about his back and forth in his conversations with executives at North American auto companies. Have you had conversations with the president or his team? We have had, obviously, a seat at the table in being able to communicate facts, their possible impacts, the challenges of the industry, and what could benefit. I always say we are able to give an opinion, one of the opinions. I hope it's a dot on the chart. And definitely we have talked to all three regions, right? Expressing what is the jobs that we have, what is the investments that we've made, and how it could impact, right? Definitely that is the conversation that's always ongoing.
Hey, Swami, one thing we wanted to ask you, the EV retrenchment that we continue to talk about here at Bloomberg, how is it affecting your business and the auto industry in general? You've got Ford considering killing the F-150 Lightning, Stellantis killing the Ram EV, and GM taking a $1.6 billion impairment charge on its EV assets. That feels pretty chilling. How is that impacting you guys?
In the past, we've always looked at EV, and if you look at some of the comments that we made, I think we were a little bit conservative, but definitely the North American EV penetration has had an impact on us. We came back and talked about the impact of our revenue going forward in the August, I think, of 2024. But the key thing has been how we've been able to pivot. We had our peak CapEx spend in 23, 22. We got back to the sales to CapEx ratio, shows our agility in being able to get back and, look at optimizing how we can reuse some of the capital with the help of the customers and so on and so forth. But overall, EV, I think in other regions continues. And as a global company, we see that continuing in China and Europe. But when it does come back, and we still believe EV is a secular trend, the take rate is very different than what we all expected a couple of years ago. But with the investments already there, with the development that's behind us, and our ability to hit whether it's an internal combustion engine or a BEV or a hybrid, that flexibility in our product line has helped us weather the storm pretty well. And I think that's what we need to continue to do going forward.
I know that the decisions you make now are decisions for 4 years from now. So are you changing product plans to develop more gas-powered vehicles or to help make supplies for more gas-powered vehicles?
Yes, Tim. I think we have had a lot of content in, obviously, the internal combustion engine platforms, right? And as some of these programs are delayed or pushed out, we continue to get leverage on the existing programs, and we continue to win. The other thing to note is a lot of our products, almost 80% of our product is propulsion agnostic. That means whether I make a mirror or a door or a structure or a seat, we'll make it for whatever propulsion it is, right? So as far as we are flexible and continue to do that in our processes, we've been able to take advantage of that flexibility and gain market and continue to grow our revenues.
Swami, just 30 seconds here. Any signs of a U.S. recession, a global recession? What's the word that you would use to describe the marketplace right now? Just quickly.
Yeah, I think there is signs of stress, I would say, and obviously that puts us all as on a cautionary foot. But like I said, from our auto industry, the inventories seem normal. The average age of the fleet is pretty high, so we are looking for auto demand not to be impacted that much, but we still remain very cautious.
I gotta say, I need a new car pretty soon. So my car's over 10
Just get
years
one from
old.
Matt Miller.
I know. Yeah, he's got a bunch. Hey, Swami, we always appreciate when you carve out some time for Tim and me and the Bloomberg Businessweek Daily team. Swami Kotagiri, he is Chief Executive Officer of Magna International, joining us from Troy, Michigan on this Monday. Thanks again.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.